Okay, for those of you who've picked up this at presentation number 7, my name is Mark Fielding-Pritchard. I'm the senior partner here at a little accountancy practice called ME Fielding, and we have some 40 plus years experience of implementing IPSAS and implementing IFRS. The purpose of these courses, and we're up to number 7, I'm guessing there's going to be a lot more than the original 10 I anticipated, therefore, is to assist people who are about to be going through or are currently going through implementation, particularly of IPSAS, but also in that sense of IFRS. There are, in our experience, there are, to our knowledge, 1,001 websites that will go through the individual standards and explain the individual standards to you. So we don't have any desire to recreate that work or to compete with the excellent work done by websites such as IPSAS, which is the Deloitte's website. As I said, therefore, the object of this talk and all of these videos that we've produced is to give you an insight into the areas which are going to cause you issues, where you will have discussions and so on, and to assist you with that. So, property, plant and equipment. Let's move on. Having said that, we don't do accounting per standard. You will see, of course, that the first slide that we have is a revision of debits and credits. You need to understand the debits and credits, so we'll just give them to you very, very quickly. But I hope that if you're watching this and you're still with us and you've liked us on Facebook and subscribed on YouTube, that you will know all of this stuff anyway. So on the 1st of January it says we being a ministry or government department therefore purchases a motor vehicle for $60,000. So presumably that this country uses the US dollar. The motor vehicle will run for 5 years and is anticipated to have 0 scrap value. Life of musical instruments. Life of motor vehicles therefore will be set as an accounting policy, and 0 scrap value is probably an accounting policy as well. On that basis, the monthly depreciation is $1,000. I hope everyone understands what depreciation is. Depreciation measures this fall in value of the asset. That's the measurement of the expense of the asset. So monthly depreciation will be $1,000. If it's a standard Oracle system, then depreciation will actually start in the month after acquisition. But I think here we assume that it starts in the month of acquisition. So therefore, at the end of the year, we will have depreciated by $12,000. At the end of 2 years, we will have depreciated by $24,000. So if you look at statement of financial position, which is a fancy phrase for balance sheet, at the 31st of December, at the 31st of December, the thing will have been in our books and records for 2 years. Cost was $60,000. 2 years is 24 months. So your accumulated depreciation, $24,000, and your net book value is $36,000. Therefore, that will be what's in your statement of financial position as at the 31st of December 2013. I hope everyone is okay with that. If you are not okay with that, send me an email and I will go through it with you. It then says if the motor car is sold on the 10th of January for $30,000, what happens? So we will debit cash $30,000. We will debit loss on sale $6,000. We will debit accumulated depreciation $24,000, and we will credit the asset at cost of $60,000. What those two little lines are showing you is that you have a loss on sale. So in your income statement, in your financial results, statement of financial results in January 2014, you will have an expense which is $6,000 because you sold for $30,000 and the net book value was $36,000. So you have a loss on sale of $6,000. Okay, that is fairly basic stuff, and realistically, if you are in an implementation team, you should know that. If you don't know that, then go get yourself some free accounting textbooks from somewhere on the internet and work out where all that stuff comes from. If you are designing a chart of accounts, you therefore need to have fixed assets at cost, or property, plant and equipment at cost. You need to have accumulated depreciation. You need to have loss on sale. You need to have cash, and that's about it. That's all the accounts that you actually need. Oh, and you need depreciation expense as well, because every single month you will debit depreciation expense in the income statement, and you will credit accumulated depreciation. Okay, that we've whipped through fairly quickly. As I've said, the purpose of these classes or these little lecture things is not to teach you accounting, not to go through the standard and say when do we recognise an asset, blah blah blah. According to the standard, it's simply to show you what's going to happen during implementation. Trust me, property, plant and equipment is going to be a monster. Okay. Right, I hope that's okay. As I said, if I have gone through that very, very quickly, because my assumption is that you know it, and it's just to make sure that you're okay with all the terms. If I have gone too quickly for you, send me an email. You can see mefielding.com, go to the website, contact us, and I'll put you in touch with some free training material. In fact, if you look on our website, there's some free training material there, which came from a team who are doing EU project for Russian banking. In addition to that, a gentleman on LinkedIn has sent me a link to his website where there's a massive free IFRS training, and I've got to put that up yet, so I'll put that gentleman's link up and you can use his stuff. Okie dokie, accounting for fixed assets, all good fun. So let's just have a look at slide number 2 then. Slide number 2 is to some degree a repeat of slide number 1 in that we purchase a motor vehicle for $60,000. The motor vehicle will run for 5 years, it has a useful life of 5 years, and it has 0 scrap value. IPSAS will be adopted on the 1st of January 2014. Now let's just have a little look and see what's happened then. Because now what's happened is we've got 3 motor vehicles. What this is telling us, and so this is my explanation of the slide, is that we've got 3 separate motor vehicles. The first, all motor vehicles cost exactly $6,000, all run for 5 years, and all have 0 scrap value. So let's have a look at motor vehicle number 1. Motor vehicle number 1 was purchased on 2006. Right, the implication of this is that the government therefore had a cash accounting system as at 2006. Therefore, when this car was purchased, assuming that we wrote on the 1st of January, we wrote a check for it of $60,000, whatever these things are. At that time, it will simply have been recorded as an expense. So in what at that time was called your cash income statement, therefore, you will have all of your revenues, and then under expenses you will have the motor vehicle, which has a cost of $60,000. So that's your starting point. Under the old system, it was recognised at the date of acquisition, which was the 1st of January 2014. 60 grand went through, and it was correctly accounted for under the old historic system. Now what it's telling us on this slide is that what's happening is that on the 1st of January 2014, we are adopting IPSAS. Now there is an inference here. The inference, or the nuance of this, is that this motor vehicle that was purchased in 2006 is still in use. So if the asset is still in use, it now needs to be reflected in our balance sheet. And we will in fact reflect the thing. What the standard actually says is that we will reflect it at fair value. Now on the basis that the motor car is 8 years old, that the motor car is 8 years old and presumably has virtually no value left, we're probably not going to go through the process of revaluing it. What will we actually do with the fixed asset then? We're going to show it in our balance sheet with a net book value of 0. And the way that we do that is we show it as a fixed asset at cost of $60,000, and then we reflect the fact that it's fully depreciated. So therefore your accumulated depreciation will be increased by $60,000. So we're not revaluing it, we're being extremely prudent, assuming basically that it has a value of 0, which after 8 years it probably does. We debit the fixed asset and we credit accumulated depreciation with $60,000. Right, that therefore is how we've treated an asset, because the asset had a life of 5 years, and so therefore at the time of adoption, which is the 1st of January 2014, it's completely and fully depreciated. Right, that is your asset that was purchased in 2006. Now let's move on to asset number 2. Asset number 2 is motor vehicle, $60,000. It has a life of 5 years, it has 0 scrap value, blah blah blah, and IPSAS will be adopted from the 1st of January 2014. Right, what will happen to this asset then is that it will go as an expense. So when the motor vehicle was first purchased on the 1st of January 2012, it will have been treated as an expense in exactly the same way as the first item was. Now what's going to happen is that when we get to the 1st of January, the net book value of the asset, 2 years have passed, all of 2012, all of 2013. So the asset now has a net book value of 36,000. So we have this idea of a net book value of 36,000. Everyone okay where the 36,000 comes from? If you're not, drop me a line. So how do we reflect the asset in our books and records? Well, assuming that the fair value is the same as the net book value, we will debit fixed assets that cost 60,000 and we will credit accumulated depreciation 24,000, and that will give us a net book value of 36,000. Now that means therefore that the thing has a net book value of 36,000. So for the next 36 months, we're going to depreciate it at $1,000 a month. Now, if we debit 60,000 and credit 24,000, you will see, therefore, that your accounts aren't going to balance. As I used to say to my students, my balance sheet doesn't. So your balance sheet won't actually balance. So you have to put another credit of 36,000 in. Now, what will happen in real life is that you will open an account which is called your IPSAS adjustment account. And this is going to be a number you're going to have to prove what it is when you publish your first set of financial statements. But it's a kind of I dread to use the word dumping ground, but it's a kind of a dumping ground for all of these other sides of entries. So your 36,000 will go into your IPSAS adjustment account. And that will make your accounts balance. Now, you don't need me to tell you that the mathematical effect, therefore, is that what is going to go through your income statement is 96,000, because what will go through your income statement, or what went through your old-fashioned income statement, was 60,000 when the thing was bought, and now under IPSAS you're going to put another 36,000 through that account. Therefore, there are various things that you can do. In certain countries that have adopted IPSAS, what they do is they create an identifiable IPSAS adjustment for this asset. And what they will do is they will release that adjustment back. So then as you depreciate the asset, you will credit their income statement with the IPSAS adjustment to reflect this. I have to say, so in other words, you're going to debit the adjustment and credit the income statement of the reversal of depreciation. So in effect, in your income statement, you won't have any depreciation, because you'll have depreciation expense of 1,000 and then the credit, the other side, equal to it. I have to say that I don't like that, because it says to me that your income statement does not reflect the fact that you're getting the use of a car. So personally, I don't like that, but some organizations like that, and we'll come on to see a thing called the depreciation trap in a minute, and you'll see why organizations particularly like that. An alternative which you can do is to credit the 36,000 not to IPSAS adjustment account, or to put it in the IPSAS adjustment account, but then to release it directly to reserves. So your organization will have a surplus or a deficit account, and over the life of the machine, or the life of the car, you can release $12,000 a year into that account. And so that account, therefore, will act as a credit, but it doesn't go through the income statement. It goes through it'll go through an adjustment to your reserves. The third thing, which some other organizations do with this IPSAS adjustment, is they just simply leave it there. Now, I have to say again, I don't like this. The IPSAS adjustment makes sense and adds value to the accounts at the point in which we are adopting IPSAS, but 10 years down the line, you're going to have this big number in your balance sheet, which is an IPSAS account, or an IPSAS adjustment account. People are not going to know what it's for, because they won't remember back to the days of adoption. And in that case, it serves no purpose, and it has no meaning. It just becomes a meaningless number 10 years down the line. So I don't like that. But therefore, you have three opportunities here: to credit the 36,000 monthly back to the income statement, to credit the 36,000 monthly to your reserve surplus, so not through the income statement but still through there, or to put it in an IPSAS adjustment account and just to leave it there. Right. as part of your implementation, you're going to have to make a decision on that if you're undertaking accrual accounting. I can tell you that the organizations that you're dealing with will want the first one. They will want a credit in their income statement. And you'll see why in a minute when we look at a thing called the depreciation trap. Okay, back to, right, we did asset number 1 was 2006, was straightforward. Asset number 2, 2012, and 2015. Right, please can you notice that at the point at which IPSAS is adopted, this asset will not figure anywhere because it hasn't been purchased. So therefore, at that point, you get nothing at all. On the 1st of January, we will debit fixed assets at cost, credit cash, assuming we paid cash for it, 60,000. And then every month, as we depreciate, you will debit depreciation expense and credit accumulated depreciation, assuming that the thing is with you for a period of 5 years, the same way as you would under IFRS. So please just notice, I don't want this to be misleading in any way. And it does say on the slide though, we debit fixed asset at cost on the 1st of January 2015. IPSAS is already in place. There's no need to make any adjustments. We don't touch the IPSAS adjustment. The IPSAS adjustment arises at the 1st of January 2014. So I hope asset number 3 is nice and straightforward. Okay, that's the accounting entries that you see for your 3 different types of assets: fully depreciated, partly depreciated, and purchased after. I think purchased before and purchased after are fairly straightforward. As long as for purchased before and fully depreciated that you don't have valuation issues, so the thing is rocketed in value because it's some super pooper car, you can just assume that the thing's worth nothing. I don't think that you need to get a valuation for motor cars like that. The one where you get the complication is the 2012. I think the asset at cost and the accumulated depreciation is straightforward, and I have never seen anyone do anything else with that. The question is, what do you do with that IPSAS adjustment? In terms of the politics of the situation, you're going to have to go with variance, and you're going to have to discuss these with departments. Credit to the income statement, credit to the, in the olden days used to be called retained profits, or your retained surplus and deficit, or just leave it there. I don't like the first one because I don't see why there's a credit in the income statement for it. I don't think it should be there. And I don't like the third one because I don't know what the IPSAS adjustment means after 3 or 4 years. It becomes a meaningless number. And people will start to point at it. What is that thing? Get rid of it. Especially if it's big because of pensions liabilities. So I would go with number 2. I will promise you your clients will want number 1. Okay, let's move on to the next slide. Okay, so slide number 3 is a little thing which is called the depreciation trap. The depreciation trap is something as well that your clients, irrespective of their level of accounting knowledge, will pick up on very, very quickly. And if you don't address it and deal with it and support their demands, you can very quickly find yourself alienated. Right, let's just have a little look then. Thinking back to slide number 2, I think what we said is that IPSAS will be implemented on, here we go, well this has got a little example in it anyway. IPSAS will be implemented on the 1st of January in a department. In 2015, the department will receive 1 million in cash and it will spend 1 million in cash. In 2012, we purchased a motor car, and oh look, again, once it cost exactly 60,000 bucks. The life of the car was 5 years and the scrap value is 0. What I want you to do, therefore, is just think about what's going to happen in 2015. In 2015, you have IPSAS. So now we have this idea of accrual based. There's so little information on the slide that you should basically therefore assume that the department will produce its accounts. Its income will be $1 million. If assuming that they have a calendar year for their budget, it receives 1 million bucks. And it's for the year, so that the cash basis and the accruals basis will give you the same. As far therefore as our expenses go, when you look at the expenses for this department, just assume again that there's no accruals. So we get the money and we spend it and it goes, I don't know, let's assume there's 4 people and it's their salaries and plus whatever else. Can you see therefore that what happens is that if you just look at it from a cash basis, what will happen is that the department will completely break even. It receives 1 million and it spends 1 million. And it's very likely that as it's a government department providing services, that that's exactly what the department is designed to do. Unfortunately, what's happened is on the 1st of January, the IPSAS come along and we've got this car. Now, the car was purchased in 2012. It's got a life of 5 years, so therefore up to 2017 we will have $1,000 a month of depreciation going through the accounts. Can you see therefore what's going to happen? The organisation is going to have a loss at the end of the year, and the loss is equal to $12,000, which is equal to the depreciation, because it's got cash coming in, cash expenses which exactly balance out, and then on top of this it's got the depreciation. Now this is what's going to happen to all of these departments that have assets in them. Trust me, I promise you, any department that this is going to happen to is very, very quickly going to realise what's happening. And that is why what's going to happen is that the department, when they say, okay, well, we've got this IPSAS adjustment, which is equal to whatever the IPSAS adjustment happens to be equal to. How many years have we had it for? We've had it for 2 years. Let's assume 3 years. We've had it for 3 years. So your IPSAS adjustment is 24,000. What's going to happen, therefore, is we want to see that IPSAS adjustment for 24,000 released to our income statement so it matches the depreciation. And that's where your pressure is going to come, because however much you try and reassure people, they do not want to see losses in their income statement. So does it make sense now why you're going to come under pressure to release your IPSAS adjustments to the income statement? So in terms of our ACCA students who have all liked us on Facebook and loved us on YouTube and so on, what will the department's financial result for 2015 be? Assuming that everything else is equal with its cash and its cash, then the financial result will be a loss of $12,000. Are they likely to support IPSAS implementation? Well, you would hope so. You would hope that they would be smart enough and the people judging them would be smart enough to know why it's happening. The reality is that they will not be. The reality is that I've never seen anyone say, oh, that's a good idea, we don't care. Everyone is against this. So they will come to you and they will say, we're doing a good job, we're meeting all of our targets, and now what's going to happen is that the big boss above us is going to show that we're making losses. And he's going to think that this is some fantastic super pooper new information coming from IPSAS. But the reality of it is that we haven't done anything. We haven't bought anything. We haven't worked any harder. We haven't worked any less hard. We just happened to buy a car 3 years ago. You need, therefore, to have your arguments ready, and you need to support those people. If that means swallowing down the fact that you have to have an IPSAS adjustment as a credit in your income statement, then it's probably best to do. What are they likely to try to do? Well, let's hope that it doesn't go so far as to shoot the IPSAS team or to try and derail the IPSAS process. The usual thing that people do when they work out what's happening here is that the first point of call will be, okay, you've got this IPSAS adjustment, and you'll be astonished at how quickly people grasp this when there's something to do with bonuses involved. Let's release it to the income statement. As the IPSAS specialist, if you want to sit in front of them and go, I don't really like that, you have to come up with an alternative. They will have a second alternative, and their second alternative will be to buy another car. That is always the next one. Oh, well, why don't you recommend to the minister then that we need a new car because there's something wrong with the old accounting policies? Somehow an accounting policy affects whether or not the car works or not. But that will be the next thing that you'll get. Trust me. So please be aware of that. It's called the depreciation trap, and you need to take that to them and explain to them that this is what's going to happen and ask them what they want to do about it. If you don't, and it suddenly pops out the woodwork when you get your draft financial statements and then they jump all over you, you're going to be in trouble. So, the depreciation trap. It occurs because of this idea that depreciation becomes an additional expense on top of cash. The alternative, of course, is for them just to cut back their budget by $12,000, so they buy a little bit less paper and they spend a little bit less on travelling and so on. But you have to ask the question, what for? Our business is being driven by an accounting entry, and you can see why people are not going to be particularly satisfied with that as an answer. That's the depreciation trap. Be aware of it. I guess I really can't overstate this slide. This is the biggest thing that you're going to come up against. Valuation issues. In most developing countries, you are going to find that the vast number of assets have nothing that resembles anything even to a close valuation. And you're probably also going to find that the government does not have, or to all intents and purposes does not have, a professional valuation department. As part of your IPSAS project, going to the Minister of Finance and telling him that he needs to find $10 million to set up a valuation department is going to be an awkward conversation and most probably a particularly short one. At that stage, the accounting standard, currently IAS 17, as does number 13, allows you a couple of little let-outs. The first thing is that you currently have 5 years, so you can adopt IPSAS but not adopt IPSAS number 17 valuation. In other words, therefore, from the date of adoption, you have 5 years to value all of your assets. If you are in a country which is particularly asset rich and which has never been surveyed to see what's there, I have to say that in real life, 5 years is a pitifully short period of time. And in terms of the new exposure drafts on first time adoption, it looks like they're actually going to cut it to 3 years, which I really can't see the point of. You can obviously adopt national standards, and so with national standards you can put some clauses in about fair value where available, or you can therefore extend the period for 10 years or 20 years, whatever makes commercial sense to you. I guess having a balance sheet that doesn't have assets in an asset-rich country at their fair value doesn't make a lot of point either. But this is something that you're going to come up with, and it's just an absolutely huge problem. Even in countries which have gone a real long way to adoption. So New Zealand is the country that is the closest to 100% adoption. You know, the cost of valuing these things is just enormous. The other thing that you come up with commercial valuation, with valuations as well, is on what basis do you actually value them at? I think if I can just have a shuffle through the notes, please remember that it's so good if you have the handouts and the downloads. And let me see what kind of slide we're at. Here we go, slide number 38. Slide number 36 here, or even 34. Here we go. When we're looking at these slides and things, the question is what are you actually how are you actually going to value these things? So the examples that I've given you in the slides are, the first thing is a military airbase. Now we all understand what a military airbase is. So this is where you've got government aeroplanes and so on. Right, how are you going to do that? Well, the first one is commercial valuation. Well, as a commercial object, a military airbase has no commercial valuation. There is nothing you can compare it to. So the second thing that we can do therefore is we can say, okay, well let's compare it to a regional airport. How does it compare pluses and minuses to a regional airport? So let's take the value of a regional airport and then let's adjust that value for known differences. That's a very a very subjective approach to it, but it's something that you can do. Right, the problem with that is military air bases, because of their very nature, tend to be a long way away from where people live. If they're a long way from where people live, then the commercial valuation becomes very low, because no one's going to drive 7 or 8 hours through the night to get to an airport when there's almost certainly going to be one closer and more convenient. So commercial valuations might be realistic. Certainly in real life, using them as custom ports. If you have freight coming into the country, you can use them as freight terminals. Again, persuading customs officials that they should move to the mountains and that's where they should set up their families can be difficult. But governments can be persuasive. So we can have some form of pseudo-commercial valuation as the equivalent of a port. So where we have custom tax-free warehouses and so on. Looking at it as a commercial valuation. Going back to it, that would apply for change of use for a military airbase as well. The other thing that you can do is a breakup value. So you split the thing into assets. So you go and say, okay, well there's some land here, there's a runway, there's some buildings, and then whatever else. There's usually petrol tanks and things attached to it, some barracks for sleeping in. Let's use these things on a breakup value, and we'll split it into 25 different assets and then value each of the assets individually. There's an assumption therefore that there's no goodwill attached to the project, attached to the group of assets, but again you can do that, and then we can say, okay, well we valued these in the city here, so we'll take, but it becomes a hugely subjective issue. The other thing that can be a problem as well is that with things like military air bases is that you can find that they have God only knows what spilt everywhere, but if there's petrol in the ground and so on, or where there's been damage by fire. So in fact, the value that you come up to comes up with virtually nothing, and then you'll find that the Ministry of Defence will not accept a valuation of nothing. So those are the kind of issues that we get there with things like military air bases, which have a value, they have a cost, which you may or may not be able to decipher or discover what is the cost of the thing, because the thing may have been built years and years ago. Right, that's the first type of asset that we really wanted to talk about, was things like military air bases, where there isn't really what we would call a commercial market for these things, and their commercial values therefore tend to be pretty low, because on the grounds that who wants them on a commercial basis. Right, second thing that you will have as assets that people do want on a commercial basis. So let's take the example of a library. A library will be a thumping great big building which is in the middle of a city. Now, as a commercial asset, it's worth virtually nothing. You have this great big building, people go in there and people spend buttons renting books, and presumably the books are free anyway. You only pay if you bring them back late and so on. Shows how long it is since I went to a public library. So with your library, therefore, so what can you do with your library? Well, with your library, then you can do a thing, change of use. And if you look at your slide now, a commercial valuation here would be the same as change of use. We say, okay, let's assume we've got this building which is bang in the middle of the capital. It's a 3-story library, the national library of whichever country we're in. What happens if we just sold it to a developer to turn into businesses, to turn into apartments or whatever? Right, the question therefore is, are you going to allow organisations which are effectively managing and controlling businesses across your country to pick the most financially advantageous use of their building and then apply that? It becomes a very, very difficult thing to do. And where do you draw the line? With a library it might be true, but with certain other things, what about research laboratories and things? Is a research laboratory that happens to be in the middle of a town worth any more than one that's on the outskirts of a town? Are we going to let them change use? And would the local committee, would the local government for property committee allow them to do that? It becomes very, very dangerous. And trust me, you will find that what the clients will want to do is include the building in the balance sheet at the maximum value to beef up the quality of the assets. Perhaps they haven't quite grasped the concept of depreciation and how that's going to hit their income statement yet. So we get the idea of public libraries. If you value them as a public library, commercially they're worth nothing. Value them for change of use, they'll become very, very valuable. But then if the change of use isn't realistic, are you going to let them do it? No real breakup value for a library. You need a policy decision. Usually for public libraries you would allow change of use. If it's a 90% developed building for offices, you'd allow that. Military air bases, just see what you come up with. You have to work out what the value is. You'll get the same as well for Navy bases. The third one which you always look at is heritage assets. So those lovely pictures of old kings, old warriors, of Lenin or whatever. People who effectively either defeated or fought with the Spanish in South America. What do you do with those? Well, IPSAS 17 gives you an out. It allows you to treat all heritage assets, or to take them out of the balance sheet. So in other words, treat them as if they have a value of 0. That is an absolutely great let out, and in every country I've ever been, you should take that wherever you possibly can. So you take that right and you just treat those things as if they weren't in your balance sheet. You've got two different problems with that. The first thing is the clients. The clients won't get the concept that what you do with one asset, you have to do with every asset. If you have a museum, they've paid $1 million for some bones from, man of Bedford from 20,000 years ago, they're going to want them in the balance sheet. Explaining to them that we're sorry, you can't have them in the balance sheet because no one else has costs for their assets tends not to go down particularly well. So you have to hammer that point home. But you will get complaints from people who have assets where they know what the cost is and they want to see that cost in their balance sheet. What is a harder decision is at what point does a heritage asset become a heritage asset? If you have a building that's 400 years old and you use it as a library, is it a heritage asset or is it a library? Once again, generally you want to try and go down the route of heritage assets. Get as much under the heading of heritage assets as you possibly can. without stretching the ethical rules or anything like that, because it avoids you having it valued. When you have a 400-year-old building that survived bombings or whatever else, that you really want to be valuing it. So in that situation, therefore, try and get everything in as heritage assets. If the client isn't going to take it, or you're under pressure from the ministry not to take it, then you're going to have to include it as an asset. And then you need to look as well, okay, what's the other use? Is it possible we're not allowed to make apartments because we're not allowed to touch them, the plumbing system's not up to it, blah, blah, blah. You come up with all of these other issues as well, which begin to kick in. At the end of the day, all in the life of an implementer. Right, two other things that we've got down here. The first is the cost of the valuation. If you're looking at a country, and it's a normal country that has some mineral deposits, that has some land, that has some parks and so on, parks we would treat as heritage assets, by the way, the cost of the valuation is going to be absolutely immense. I mean, just jotting down numbers on the back of a cigarette packet, as we used to say, you know, if you're looking at countries like somewhere like Russia, it's just going to be absolutely phenomenal. You're going to be into the hundreds of millions. And it's not just the question of the hundreds of millions, it's the volume of people. How do you manage the volume of people that you need to go out and value all of those assets? How do you even get them there as well? You've got helicopters and things to get them to certain areas of the country where there are military bases and so on. So you have to be aware of all of this with IPSAS number 17. In reality, IPSAS number 17 is probably going to be your most problematic in terms of implementation. It'll take the biggest number of people, the longest amount of work, and it'll give you the most headaches. Even if the minister says, yeah, we have an open checkbook, go hire these guys, the next thing is the technical skills. How are you actually going to train that volume of people? If you look at professional valuers who work usually, you know, in the house industry, who are valuing apartments and so on, they have lots and lots of databases of other buildings that have been sold within the past week, within the past 2 weeks, whatever. How on earth is that applicable that you can then pack them off to the mountains where there's an airbase and so on? So we need to look at the technical skills, the training of these people, what we're actually going to do with these people, and then you look at the cost, and it is a huge job. And that's kind of why I don't really understand why the IPSAS board is looking at cutting from 5 years to 3 years the amount of time to become compliant. Because if there is one area which is a real enormous barrier, it's the valuation. In terms of selling, if you're trying to persuade the Minister of Finance of a company like we looked at Raitan, wherever it was, Raistan, in an earlier discussion, you can probably sell him, if he's a smart guy, the idea of improving infrastructure and getting computers for his staff. Trying to persuade him he should set up a valuation department, which is just going to go around the country valuing assets, that's a much bigger sell. Much harder. Okay. So the final slide that we've got here now is looking at ownership issues of assets. Trust me, when you're doing implementation issues in countries, particularly countries where you've had things like they've split from other countries. So we've had, you know, Slovakia splitting away from the Czech Republic, and then the breakup of the Soviet Union. It's going to be hard enough to identify who owns specific assets anyway. Factor into that we also come up with other kinds of ownership issues. We've got a little example here. I've given you something, and this is a real example. So this here is a real example. So from a country that I worked in. The Ministry of Education, therefore, uses a building in a town. The owner of the building is the Ministry of Property. In many countries, not just Soviet countries, to streamline the procurement process, there is a Ministry of Property, and anything which approximates to being a fixed asset is purchased to the Ministry of Property. So they do all purchases, and then they do all disposals as well. Therefore, for items where there are official documents of ownership, such as buildings, such as land, such as motor cars, the owner on those documents will always be the Ministry of Property. Now, what you tend to find when you discuss with these ministries who owns these things is that all of the ministries want the assets, but none of the ministries want the liabilities, which I guess is fair enough and nice if you can pull it off. You have to kind of work hard not to let them do that. But here you can see that we've got the Ministry of Education uses a building, and it may be in some cases that there aren't even formal lease agreements. But I think in this case we had a formal lease agreement. Under the lease agreement, the Ministry of Education was allowed to make non-structural changes. They were responsible for the upkeep of the building. They were also, when you look further down, the security. They were responsible for the paying of the security. So to all intents and purposes, if you were a member of the public going to a meeting with the Ministry of Education, there was absolutely nothing that would ever tell you that this building did not belong to the Ministry of Education. The signs outside, the car park, everything said Ministry of Education. However, as a legal nicety or a legal fact, the Ministry of Property actually owned the thing. Now, the other thing that we had here was that the building, like many of these things, was guarded by the Ministry of Defence. Now, the Ministry of Defence use armed soldiers to guard the building, and these guys operate the entry desk. If they don't like the look of you, then you're not going to get into that building. Excuse me again. Right, so security provided by the Ministry of Defence. Now we'd actually, as a team, already had a run-in with the Ministry of Defence. As a team, we had a car. The car was on permanent loan to the Ministry of Finance, and we went down to decide that we would try and get our car back one day. And the Ministry of Defence soldiers at the Ministry of Finance refused us access to the car park and would not let us take the car away. So on those grounds, we felt we could not say that car belonged to us. What's the deal here with this building? Oh, we had discussions. There is a fact who controls it. I would have to say that the fact, as far as I was concerned, is that the building is actually controlled by the Ministry of Defence. Because if the minister himself phoned those soldiers and said, "Don't let anyone in," he probably wouldn't. So to my way of thinking, my first point of call was that the Ministry of Defence actually own the building because they have the control, and you know, with guns. The Ministry of Education, it appeared from the lease, could be ejected from the building on a couple of months' notice. So there was a question there that they don't have real ownership. Also, it was possible that the Ministry of Property could come in and make certain changes that it wanted to. So the Ministry of Education decided, despite the fact that if you'd asked anyone in the town who owned it, they would have said, "Oh, Ministry of Education." The Ministry of Education was quite clearly not really in control of the thing, despite the fact I think they'd been there for over 20 years and no one had ever raised an issue with any of this stuff. Our third contestant, therefore, was the Ministry of Property, and the Ministry of Property was completely adamant that they owned it. The lady from the Ministry waved around the ownership piece of paper in front of us a great deal, and we explained to her what it meant. She pointed out, and to be fair to her, she was very, very persuasive. She pointed out that not only did they own it according to the documents, but she also had the right to fire the Ministry of Defence. The Ministry of Education, if they had decided to move the Ministry of Defence, it may have been difficult, but the Ministry of Property had absolute right to remove them. Therefore, we came to the conclusion that the Ministry of Property was the owner of the building, and the building stayed in the balance sheet of the Ministry of Property. There were then leasehold improvements which we left in the building of the Ministry of Education. Having looked at that, I have to say as well that there was kind of pressure on us to come down on the side of the Ministry of Property, because I think the question was going to arise in the country: if they held all this property but they didn't control any of it, then what did the Ministry of Property actually do? You were going to have accounts for the Ministry of Property with no assets in it other than some computers and tables and the odd building that they owned themselves. So therefore it kind of made them a little bit meaningless. And so ultimately it was a good political decision that also gave us a correct accounting decision. Right, that therefore is the kind of thing that you're going to come up with over and over again. IPSAS 17, it goes in the balance sheet of the organisation that has control of it. Who has control of it will not be completely obvious. You also get buildings where the top half is owned by the Ministry of Education and the bottom half is operated by someone else. And in those situations, you're almost looking at joint venture accounting. We certainly had some, and not in Kazakhstan, but we also had some in other countries where we've had a building which is owned 50-50. And the owners of that, the two ministries in that building, I can't remember which one it was now, I think it was Transport and Education or Transport and Health. And basically they had a committee, and the committee made decisions about when they should buy new generators, when they should renovate the ventilation system and so on. And on the grounds that they had a committee and both of the organisations had a 50-50 vote on the committee. I think they took it in turns to have the chair, whatever it was. But in that situation, you can actually end up with a situation where you have joint venture accounting. So we can employ the standards, we use the standards on joint venture accounting, but you have to fulfill the criteria that it is a proper joint venture. The building is properly owned 50-50 by two organisations. There it is controlled by some form of steering committee, and each organisation has a proportional share on its steering committee. You know, we get other organisations within the UN who try and pull the joint venture accounting rabbit out of the hat, but at the end of the day, there's one organisation that controls the building and is responsible for repairs and security, and that organisation controls the building. Okay, that's a quick brief look at IPSAS number 17. As far as the accounting is concerned, the accounting should be fairly straightforward, and the accounting generally doesn't give people any problems. You get problems with these things which are in the detail. The devil's in the detail, yeah. How do you value them? The valuation is just a monstrous task. You get issues with ownership. The third thing that you get issues with as well, which is possibly something which we should have a slide on, but it's as a lecture topic, it's very, very straightforward. In real life, it's incredibly complicated. And that topic is the cleanup of your assets. And when I say cleanup, even if you have a system, so in some database you have details of all of the assets, what's going to happen is that you're going to have a common accounting computer system, a common accounting ERP. And so what will happen is as you go through the process of purchasing, you purchase things. The purchase system notes the flag. Your tables in your computer have a flag on it. It picks up the flag that this thing is an asset, and it posts the information across to the asset module. And you need to know how it's doing that, when it's doing that, and it needs to do that correctly. For that whole process to work, your asset module and your purchasing module must be compatible. In other words, therefore, what you basically have to do is you have to download all of the data that relates to all of the assets for the whole country, clean it. Now, when I say clean it, it may be perfect in the fact that the description said this is a computer, it cost this, was the date it cost on. But the descriptions of those assets and the form in which the money is put and the form in which the date is, for all of those things have to match exactly the ERP system that you've got. Even dealing with someone like a small agency in the UN that only had 6 million cost of assets, which is absolutely tiny compared to a country, it's still, you're uploading assets into the accounting system in batches of 30 or 40, and almost every batch is getting stopped because, you know, this doesn't match and this doesn't match, and it doesn't go to the right classification. You can get computer programs now from Oracle and SAP that will help you clean up your data, but I really can't understate how big a job that is. And you know, it's 5 minutes here and you think it's tacked on, there's not even a slide, so maybe really not all that important and so on. But at the end of the day, it really is an absolutely massive job, and it really is so detailed and so painstaking. Okay, those are assets. Thank you very much for listening. Like us on Facebook, you know, all the rest of the stuff. Stay tuned for number 8.